Markets continued to simmer in overnight trading, with particular strength in Europe leading the global share markets. In overnight trading, the Nasdaq finished up a little over 0.75%. That was its best level all day. So it was a slow burn across the trading day in the US. S&P 500 up a little more than 0.5%, just like the ASX 200 yesterday, up a little bit more than 0.5%. So the positive momentum in share markets continues. As I say, led by those European markets, the FTSE 100 hitting its highest level ever, and the DAX and CAC also recording good gains in overnight trading. All of those up by more than 1% and outstripping the rest of the globe over the last 24 hours. But nonetheless, positive momentum in most markets. In the US, we saw good support for a number of the tech stocks that have been under pressure. Micron was up 5%. AppLovin and Doordash up 7%. And yesterday here in Australia, we saw NAB up 4% after its trading update. And a lot of the action that we're seeing in markets is driven by results at the moment, whether we're looking locally or in the US. And so the focus on company earnings reports is likely to continue. We did, however, see commodity markets in action overnight. Oil was up 5%. We saw very good support for metals. More on that in a moment. There is some talk, particularly in the Fed minutes, around a potential rate hike. The market doesn't seem to have seized on that at the moment. We did see slight backing off in bond markets, with the US 10-year rising to 408 from 406. That's after a sustained rally down from 4.25. So a little bit of backward pressure there on bond yields, but nonetheless, that talk of Fed rate hike, or the potential Fed rate hikes rather than cuts, doesn't seem to have fed into equity market action trading overnight. Today, we'll hear from Rio Tinto after the Australian market closes. Tonight, we'll hear from John Deere and Walmart in the US. So not only will we get a good read on those individual companies, but John Deere will give us some sense of how rural America is faring, and Walmart, of course, the overall consumer outlook. So plenty to drill into in the US results out tonight. And of course, there's another 100 or so companies reporting. However, a focus today for Australian investors is likely to be the resources sector. Now, this is where we've seen outperformance over the course of this year, and in fact, beginning last year. And it's largely due to the underestimation of demand for many of the metals and other commodities that feed into the global industrial complex. So copper, gold, and silver back on the rally last night. We saw gold markets up by more than 2%, silver up by more than 5%, and copper also on the rise. For 2025, just as a quick recap, silver was up more than 100%. Copper was up more than 50%. Of course, the gold story is very well known. So in February, we saw a reset of a lot of those prices. I would argue that a bubble burst, price action had got too steep, but that technical aspect of the market appears to be working its way through. Many analysts now arguing that fundamentals remain in place despite that bursting of a bubble, and that there could be further gains for metals across the board. Now, demand is strong. We've got AI demand feeding into particularly copper markets, but also silver. There's hedging. We've got industrial uses for a lot of these metals, and supply issues coming up, particularly in copper, where underestimation of demand has led to a lack of large projects. A number of analysts have very significantly high targets for these metals. In gold, a number of US banks, including Goldman Sachs, have targets around 5,800 by mid-year, based on the idea of a weakening US dollar and potentially rate cuts to come. That scenario is in question at the moment. There's no doubt about that. That mention of rate hikes in US Fed minutes is one pointer to that. The other, of course, is the pricing of interest rate futures, which has seen them back right away from the concept of 2 to 3 rate cuts this year to now pricing just over 1. And of course, if that trend continues, we might soon see US interest rate markets pricing rate hikes. And if that's the case, there's likely to be adjustments in asset prices across the board, including shares. But nonetheless, If we do maintain that scenario of lower growth, lower inflation, and therefore lower interest rates, gold targets around 5,800 US dollars are not out of the question. Copper, we're seeing a similar bullish outlook, but based on very different factors. And although the potential for US tariffs remains a concern for copper traders, the Chinese demand has been underpinning the better performance of copper, and the fact that we're now looking at 9-year highs for copper markets, whether we look at the LME or the US trading. On LME copper, there's targets around $13,000 a tonne. And of course, that's significantly higher, and would see in US terms a rally back towards those highs around $660 a pound. So plenty to watch out for in copper markets, and underpinned by that surging demand for copper by those who are building the infrastructure for artificial intelligence. Silver seems to have a similar situation. There's an argument that silver is in undersupply. Its applications industrially have underpinned the gains. And while we often look to the gold-silver ratio in the precious metal sector, I'd argue it's that increased demand, and the marginal swing factor in silver is, in fact, its increased industrial use. Tech demand continues to grow for silver, and that, once again, has seen the market globally underestimate demand, and the supply has not yet responded. So that undersupply has a number of analysts very bullish, targets around $150, and potential upside across the precious and base metals complexes. So naturally, that should mean that we'll see further focus from Australian investors on the resource sector today. Regis has delivered a stunning result in the gold mining sector. Regis profit for the year was up 265%. It's announced a dividend of 15 cents, not common in the resource sector. And all of this came about despite the fact that the volume of gold sold dropped by 8%. So clearly the higher prices are really having a significant impact on the bottom line at Regis. The company has affirmed its guidance for the year. A number of analysts have a buy rating on the stock, and just this year the shares are up a further 12%. However, it's up 167% in 12 months. Now, that compares to the broader gold sector in Australia of a gain of 126%. And investors will be asking themselves whether or not that outperformance is deserved. And I would suggest that 265% increase in net profit speaks strongly to that. And whether or not that outperformance from Regis against its peers in the gold sector will continue. I mentioned Doordash's 7% gain during US trading overnight. In aftermarket trading, it's up another 11% after releasing its fourth quarter result. Orders for Doordash, despite the fact that it is a mature business that seems to be gaining market share from its competitors, the fourth quarter orders were up 32%. An extraordinary delivery. However, pardon the pun, but fourth quarter sales and profits both missed analyst expectations, as did their guidance for this quarter. And the main reason for that seems to be Doordash investing further in their business. But clearly, so far, investors are impressed with that commitment and the growth that they're getting. Share price is down 24% year to date to $137, and most analysts have targets well north of $200 for Doordash, with a strong buy rating on it. Against that, I would point out that despite that huge fall in its share price, it's still trading on a PE of around 88 times. There is not any way we can consider this stock cheap on valuation levels. So it's a tough one. It has traded much more richly. At one stage, its PE was closer to 200 times. So it could certainly do that again. But a strong argument in Doordash. I think the one thing that we can remain assured of is that volatility in Doordash shares is likely to continue. And looking locally, our third stock on our watch list today is Telstra. Now, it's just delivered a 9.4% increase in its first half profit, and it did so on flat revenue. And it speaks to the efficiency gains that Telstra is now getting through the rationalisation of its product suite that it started years ago. Telstra also announced it's increasing its buyback by 250 million. That means that the buyback total is now 1.25 billion. It's also reordering its workforce with the sacking of 1,000 workers. So far this year, its shares are fairly flat, but over the previous 12 months, it was up 24%. It's at multi-year highs. And despite that fact, a number of analysts still have a buy rating on the stock. And if it breaks through that recent all-time high, it will technically be in blue sky territory with potential for further upside for Telstra.